So here is our second half of our review for the Advanced Accounting Test 2. We have a parent company that acquires 80% of the sub. They provide us with the acquisition accounting premium detail, and they'd like us to prepare the consolidated balance sheet right after the acquisition. So I've kind of set the shell of it up. But so since we're just right at the acquisition, there's no C or D entries or I entries, anything else to deal with. We're just dealing with E and A. So we still eliminate all of the subs, common stock, paid in capital, and then retained earnings. Again, just picking those up right off of the balance sheet. But then here is where we're going to come in and say, okay, let's sum these. This is our total equity. But now the parent is only owning 80%. So I want to multiply that amount by 80%. And then the NCI gets the remainder. So then I'll take that total again and multiply that by 20%. So they're splitting it. So we eliminate all the equity, but again, split between the NCI and the parent. Then we come down and we do the same thing with our A entry. So now I got to go back up. So it tells us that the property, plant, and equipment is undervalued by $100,000, that the patent is $200,000, and goodwill is $300,000. So again, I'm going to sum those, and then the parent is entitled to 80% of that because they own 80% of the sub. So I'll multiply that times 0.8. And then the same thing with the NCI. They are entitled to 20%. So I'll sum those and then multiply that by 20%. So then I've built my entries. Now I'm going to come over. I'm not going to worry about color coding them. I'm just going to put them in. So our E entry, again, eliminate the subs, common stock, eliminate the paid in capital, and then eliminate the stockholders' equity, the retained earnings. Then we come up to our equity investment. And again, just the 80% goes to the parent, and then we come down to the NCI and set the NCI up with their 20%. Then the A entry we're going to do set up our assets. So we've got property, plant, and equipment at $100,000. We've got a patent at $200,000, and then we have goodwill at $300,000. And then the parents get 80% of that. And then the NCI gets 20%. So then that's, again, just fairly basic. Just we go through the exact same debit side, eliminating all of our equity of the sub and setting up the new acquisition accounting premium assets. When we get to the credit, we just split it based on ownership, 80% parent, 20% NCI. Okay, then this one we have assumed that the parent company acquired 80% of the subsidiary. The acquisition accounting premium was $75,000 relating to a customer list with a 5-year service life. During the year of 2019, the subsidiary recorded sales to the parent in the amount of $150,000 with gross profit percent of 30%. And at the end of the year, the parent held a 20% of those intercompany goods in their inventory. So what is the net income that's attributable to the NCI? So the NCI sold to the parents, the subsidiary sold to the parent. So that means the NCI is going to share in that inventory adjustment. So we start with our subs net income. So we pick that up, we pick that up right off of the income statement. And that is the $201,100. Make that a number. Okay, then we're going to adjust it for the premium, the amortization of the patent. So it tells us that there is the acquisition accounting, it's customer list. Acquisition accounting premium is $75,000 related to a customer list. So $75,000 divided by my 5-year service life is $15,000 a year that we need to amortize. So I'll subtract that out. Then we've got the deferred gross profit in inventory. So then if we look at that, it tells us that the subsidiary recorded sales to the parents of 150 with gross profit of 30%, and 20% of that was left in their ending inventory. So 150,000 times 30% times, I don't know if I need those parentheses, it'll yell at me if I don't, the 20% that's left. Put a little equal sign in there, see what it gives us. So that's $9,000. So again, though, we have to subtract it because it's left in ending inventory, so we can't record that profit. And then we're going to subtotal those. So that is our, like, adjusted, net income. But then now we've got to split it to say, okay, 80% goes to the parent, and then 20% goes to the NCI. So if I take that adjusted net income times the 80%, that's my parent's equity income. And I'm going to make it go to that. And then here, if I take that adjusted amount times the NCI's percent, that's going to be the net income attributable to the NCI. If I can type that. Okay, so then that is what it's actually asking for. So it's asking for what's the net income attributable to the NCI. So it's going to be that piece of it. This would be what we would find on the parent. Okay, this finishes up the test 2 for advanced accounting review. So then now problem number 6, we have a parent that purchases 90% of the interest of the sub. They have acquisition accounting premiums, $350,000 allocated to equipment, or no, $350,000 total, $125,000 allocated to equipment, amortized over 10 years, a patent, $150,000 amortized over 10 years, and then goodwill for $75,000. Last year, the subsidiary sold property, plant, and equipment to the parent with an upstream gain of $36,000, which would have been dealt with last year. What we have to deal with this year is the $6,000 gain that is amortized due to the change in the depreciation rates. So if we come down, and our first step is to figure out, well, let's just kind of analyze the income. So our subs net income starts at $155,610. Then we're going to adjust it for the depreciation of the equipment, $125,000 divided by 10 years, $12,500. We're also going to adjust it for the amortization of the patent, $150,000 divided by 10 years. And then now the gain. So the gain is that the parent would be taking too much depreciation on that property, plant, and equipment. So we want to add that back. It goes the opposite direction. Okay. So then when we plug those in and we say, okay, our adjusted net income that the parent and the NCI are splitting is $134,110. 90% goes to the parent, 10% goes to the NCI. So they want us to prepare the consolidated income statement. So you kind of have to do this step just to double check it. But then we'll come up here, and again, you don't have to do all of your journal entries, but you know some of the steps. So we're going to get rid of our equity income. So we debit that out. We are, and this I think was already, I already put that in. So that would go in, though. You type that in, the $13,411, what is attributable to the NCI. Then our operating expenses with our D entry, we would come in and we would record the depreciation and the amortization of those acquisition accounting premium assets. And then our final entry would be the I gain, and then we would be amortizing out that gain or recording that gain based on the extra depreciation that the parent has taken, and we're offsetting that. So then those would go in, and then this would be your double check. So you'd say, okay, my net income attributable to my parent is the exact same as the parent's net income. I've zeroed out my equity income. So all of that balances out. So we're good. So that's all you have to do is just prepare this. But again, this little computation down below helps you to do that. Okay, then we come to our bonds, and it says, assume the parent company owns 100% of the subsidiary. The parent company uses a full equity method of accounting. The subsidiary issued to an unaffiliated company $2 million face value 10-year bonds, 8% for $156,000 premium. Then 3 years later, the parent acquires those bonds for $1,742,500. So we want to first figure out, well, what's the carrying value of the bonds on the sub's books? So they issued them at $2 million, but then they had a premium. Now the premium is it started at $156,000, but it's going to be amortized over the life of the bonds, which are 10 years. So $156,000 each year. Well, we're 3 years into it, so if we take this minus this times that gives us $109,200 left on our premium, and then our bond payable just carries over. So right now, our carrying value is going to be the $2,109,200. And then we'll compare that to what the parent paid. So the parent paid $1,742,500, so they obviously got a really good deal. So then they paid less than what was owed, so we would have a gain. So we'd have a $366,700 gain on the retirement of that debt. Then we have a double-sided problem where we're determining just the gain or the loss and then the amount. So the parent issues to an unaffiliated company bonds that have a par value of $200,000. The unaffiliated company paid 105% of those bonds. Then 6 years later, the sub pays $207,000 for all of the outstanding bonds. The bonds had a 10-year term and 8% interest rate, and it's paid annually. So the parent started with the bond payable of $200,000. They would have been, again, at a premium. And the premium would be the 5%. So $10,000 premium. So if they were 10-year bonds, they would have been amortizing those out at $1,000 a year, right? That's our amortization. So then after 6 years later, the bonds payable are still $200,000, but it's just the premium that's going to go down. So it's going to be the $10,000 minus 1,000 times 6 years. So then our carrying value at that time is going to be the $204,000. Then the sub paid $207,000 to retire those bonds. So then now in this case, they didn't have such a good deal. There still might be reasons they would choose to do that, but they would actually have a $3,000 loss because they paid more than the carrying value. But again, maybe interest rates are changing and it doesn't matter. It's worth paying that loss because they want to get rid of them, take them off the books. Okay, then the next scenario is a little bit more challenging because it's 70%. So the sub issues to unaffiliated companies bonds that have a par value of $500,000. The unaffiliated company paid 97% of the par value of the bonds. So 5 years later, the parent then buys 70% of them back for $360,000. So this one again is going to be a little bit more complex, but we start with a bond payable of the $500,000. And then in this case, there is a 3% discount. So then that will actually subtract. So then initially they would have been $485,000. These two are 10-year bonds. So we would be, dividing that by 10. I cannot type today. So then, and then it's after 5 years, we would have again, the 500,000 never changes. That's always what they owe. But what changes is our discount. So then it's going to be this plus this times this. And it's really minus, right? Minus. So the discount goes down. It's basically in half to 500 to the 7,500, and we're going to subtract that from our 500,000. So that gives us a book value of $492,500 when the parent acquires them. But then now we have to multiply that times 70% because they're not acquiring them all of the bonds. So that times 70% gives us $344,750, and then they paid $360,000. So again, they don't have a gain. They paid more than what they owe, but there might be reasons that they do that. So again, they'd have a loss. So you kind of have to just run through the math of that. We're not doing the journal entries, just figuring out, hey, do they have a gain or a loss?